So as you guys know, I just started this cohort of mentoring at Techstars, the tech accelerator that's backed by like 70 VC firms. And it was a wild reminder that I live and play every single day in a world where I try and make businesses cash flow positive today. And every day I'm fearful that they won't be positive tomorrow. And I just spent the entire day with a group of people that all they care about is growth, and profitability is not something that comes for years down the line. And it's just mind blowing to me that there are two completely different schools of thought of how to build businesses. And I don't think one is right and one is wrong. You just sort of need to pick which one is the right one for you.
You know, I say this as someone who's been active really for years in a business that's more focused on revenue than profit per se. But I can't believe that we're still in this place where there's so many companies in the VC ecosystem that are able to raise on that concept. I get it for the Ubers of the world, maybe certainly, you know, moonshots, literal moonshots like SpaceX or Tesla, where the level of innovation is kind of like out of this world. But I think there's so many companies that are taking that approach because it's doable. You can raise money and kind of do it pretty low risk, rather than just being a cash flow positive business out of the gate. That obviously doesn't work for everybody. But I have a particular distaste on the ones that could be and aren't because they've decided not to.
Well, and I feel like we had this world in fundraising where we started off where they were giving people runway to be able to determine what they want to do, find product market fit, but you still had to be like, you know, have at least a little bit of sense of, okay, how much money do I have? How much runway do we have? And then over the last 5 years, valuations started to just get to such a massive volume that it took away perspective. Because I remember I was at a company and I was like employee one after the 3 founders. We raised $6.5 million seed. It was the biggest seed round ever in Austin at the time. And I remember everyone was like, well, what do you even do with that money at a seed level? And now like 15 million seeds are very, very common. And like that kind of perspective totally shifted. And to the point of like, you don't need that much money at that level. And I think that we've talked a lot about bootstrapping versus venture. And I think I encourage almost every entrepreneur, unless you have some grandiose idea, even if you do, bootstrap to some certain amount of as close to product market fit as you can. Because then when you get money, you're gonna have a better idea what to do with it versus now people don't actually have a concrete plan of what to do. And I think that's the key problem.
Yeah. I just, again, I think there's so many people that are taking that path and really just therefore avoiding having to go and build out a sales team and close deals because you've got a piggy bank to rely on. And to James' point, that's one path to take. But I don't know, it's an unnecessary way to dilute yourself. If you are that founder, you end up a year or two into it and you've already got, you know, you're down to 30% of the company instead of 100% if you had gone out on day zero and closed a deal or two.
James, when do you think a company should take money?
James.
Interesting. I think it really depends on a couple things. Part of it, like, and without saying the names of the companies I worked with today, you know, one of them basically creates heat shields for rockets, right? Like they need money, right? From day one, candidly, right? There's no sort of like profitability. Their TAM is 100 like agencies and businesses in existence on the planet that might ever buy from them, right? So A, their go-to-market strategy is wildly different than like a direct-to-consumer brand. And B, obviously,
that's reasonable.
They have to raise a good amount of money right off the bat. I think that capital raising should happen under two circumstances. One is in which there's, to Colin's point, you're in such a moonshot and there's so tech and development heavy that it's going to cost a huge amount to get something to create the MVP or create this actual product or prototype. And then two is when you have a fire that needs gasoline to be poured on it. But candidly, often I think in the right environment, debt would be where you would go for that. Right now we're watching the Fed is raising rates again and again and again. You know, cost of capital gets more and more expensive. Debt costs more and more to take. So you're less likely to, take debt than you would have, 6 months ago when it was basically free money. But those are the two scenarios. I think you guys are both right in terms of Oren's perspective of like the size getting massive of these rounds. Although I think it's going to shrink up a little bit. And I think Colin's perspective of there was a few companies today that like really could just be profitable up front. And they were great companies, smart founders, great ideas. But what happens when you hand someone a check at a seed stage, they start thinking about all the different things they can do. And there was a couple of people that were like trying to create 3 businesses in one, Whereas I know if they had been bootstrapping, they would have just gone to sell one product to one person and found profitability with that first. So that's my roundabout.
You get into this conundrum as an investor. And I've dealt with this myself, where I feel like if someone has a good cash flowing business where they have a certain amount of money and you're trying to go invest in it, if they don't need it for something, if they don't need that money for working capital, right? They can go get that money cheaper from a bank or from another solution than they can diluting themselves for equity. So they need it for some big new effort. Those don't come along that often. So instead, the businesses you have opportunities to get in as an investor are either unprofitable and are existing, or they're just starting out and you're kind of funding that. And I've been struggling a lot with, okay, what is that perspective or those metrics I want to look into for a business or a company that isn't in that right shape? They're not cash flow positive. They're just starting out. How do you evaluate that and know your capital is going to go to good use? And I do think that's where, repeat founders have the biggest advantage, or founders who have been in cash flow positive businesses before, who know what it takes to kind of round that corner and expand. And I think that that's a key criteria. And then the hard part is if you only look at those and you're leaving out, potentially talented people who may not have the same level of guidance, who might be building something really interesting.
So a business comes to mind that I think has kind of come full circle on this. The last time I was in Austin with Oren at South by Southwest, I found myself on a Byrd scooter, and the whole, Byrd, Lime, all these different ride sharing, scooter sharing apps that came out of the gate a couple years ago with a truckload of VC money, just taking markets by storm and burning money doing it, have all come full circle back around to when you go and get a Byrd right now, the price is not nearly as compelling as it was a while ago, because those businesses have all gone, okay, we have 1 million scooters now and we have to stop burning money and we have to make this a real business. And I think there's kind of not this most recent class, but the class before it is all hitting that stage, or they've gone public and they've hit this place where the public market is not appreciating the amount of cash that they're burning. But the Byrd scooters are the most interesting one, because
I'm still surprised how much money
they have to spend so much.
Well, because it was the hardware companies, like the antithesis of what a lot of VCs always look to. Like, whenever don't do hardware, but then here's $150 million because I see all these kids writing it, and it's
yeah. I think the interesting thing about that is A, that they're a blast, and B, they haven't gone away. Like, I think even at these new prices, the last time we used them, I think it was probably twice the price of an Uber for the the 4 of us to scoot wherever we were all going with our independent rentals. But they're still a blast, and they have a place in the market for sure.
Yeah, I think they're a lot of fun. I mean, I very rarely use them, but I think I've mostly used them for fun.
I've seen you riding city bikes multiple times on Instagram.
I love the city bike. Move. Dude, that's the old James trope from before you guys knew me, was like, I always, every day, like world building, every day without fail, I'd hop on a city bike and go to Equinox. And that was like the joke between my friends and everyone was like, that's all James did. And it'd be like snowstorm in New York City, 12 inches of snow, me just like bundled up, like city biking through Brooklyn to an Equinox. Like that was the energy. But before I lose my thought on this, really fascinating. First of all, basically to Colin's point, all that stuff was subsidized by VC dollars, right? Basically the cost of Uber rides being cheaper in the beginning, cost of Byrds, all that stuff. But there's a great little anecdote, and I'd love to try and find the link of it, where there was someone who basically was learning that they could get free Grubhub credits, and was ordering pizzas from their own restaurant with free Grubhub credits and making money just off of ordering their own pizzas and never having to deliver the pizzas, because they were just getting fulfill the pizza. And all that, again, just subsidized with VC dollars. I think it all feels so it feels so like ethereal and not real to the average Joe. But what they don't recognize is that when VC dollars, I think statistically, something like 50 cents of every venture dollar goes to Google and Facebook ads. And when these venture-backed companies just spend money on Google and Facebook, since it's a marketplace and there's only so much supply and there's more demand, it makes the price of ads go up. So it ends up happening, you end up pushing out all these bootstrap businesses and all these small businesses that are actually trying to run ads and can't, because they are just competing against this gushing flow of capital that doesn't care about profitability yet. So we're going to see what happens, I think, as venture has dried up a bit this year. I read recently there's a lot of dry powder sitting aside that has to go somewhere soon in the venture world. But we're going to see what happens in the next 12 months in terms of venture raising. It's a totally different dynamic than it's been, I think, for the past decade.
Yeah, and that's something that's on your list. Go ahead, Colin.
That exact dynamic is, what killed Colin's Scooter Company. We were just getting off the ground, and the customer acquisition cost was just buried by Byrd. Byrd took us out.
But yours was just razors that you would go drop off, right? You were like,
yeah, well, it was a razor, and then I was like teaching people how to ride. Yeah, it was.
Sick.
It wasn't very.
While legendary in Portland just couldn't.
Yeah, it was a Southeast Portland thing.
This is why you can't develop businesses in Portland, because these things will succeed that just can't catch traction in the heartland. You know what I mean?
Yo, on a serious note, so I was with my golf coach last week, and he was telling me that his brother got one of these e-bikes where it's a bike with an electric motor, and so legally, if the human is pushing the bike forward, if the human is the primary propulsion, then you can have these motors, and it's still considered a bike. And he was like, "Yo, my brother's goes 40 miles an hour." And I'm super worried about it. Like it is totally unsafe. But because while he's going 40 miles an hour under the electric power, he's also like very casually pedaling.
Very casually.
It's legal,
or like
and
James,
it's a bike.
Instagram story looking down at the pedals. And the other.
Yeah, it's crazy. It's a bike instead of a motorcycle because you can pedal too, and it's definitely dicey.
I love it.
I think it's interesting around that. The subsidized dynamic is James mentioned, 50% of every dollar that was going to venture at some point was being invested back into customer acquisition with Google ads and Facebook ads, Instagram, et cetera, to be able to bring customers in. So that money was getting recycled into the ecosystem, right? It was saying, hey, that's actually going to fund, both those companies have venture arms, both those companies acquire it, both those companies pay employees who gain skill sets, who start their own companies. But now, as TikTok becomes more and more of a major player, with that money going to China, into like a completely separate ecosystem, I think that radically changes the dynamic into this kind of more global flow of wealth, which I think is a real interesting change. I'm not sure kind of what comes of that, but I know it doesn't have the same benefit for Silicon Valley that we've seen since, the last 10 years go by.
I would argue diversifying away from just that one location is probably generally a good thing. And I'm definitely
a good thing for innovation
China
overall, but not necessarily. It depends what China will actually do with that money and allows to happen, because it's a much more limited ability to kind of launch within there. I think it could be good for ideation if it again spreads out completely globally, but then also, in terms of America remaining as a superpower and being an innovation hub, a lot of what, while we're not the kind of captains of industry and trade and finance that we were in prior generations, we are still like where technology happens. So anything that drifts away from that, besides our Swedish brothers at Spotify, I don't know if that's going in a positive direction.
And our Canadian brothers at Shopify.
Yeah,
true. And our,
they're not doing so hot.
That's all I got.
Markets, Shopify. Shout out to Shopify,
please, with whatever's left.
Yeah. If you have a small budget, we are also flexible.
Shopify apps. Y'all want
We take options, warrants, RSUs, common stock, cash. We take
3 months of Shopify Plus.
We don't take Canadian cash though. That's
we don't take CAD.
We don't take CAD. We take US dollars.
And certainly we won't take any shares on any Canadian exchange for obvious reasons.
For sure. I guess to finish, I actually found the thing, and this is some of my point about this. But so what was happening was DoorDash was basically this guy had a pizza restaurant, and DoorDash, his pizza sold for $24, and DoorDash was selling it as a special for $16. But they were paying him the full $24 to keep him on DoorDash as opposed to going to like a Seamless or something. And so venture is broken when there can be a system in which the man can continuously just order his own pizzas and pay $16 for them, and DoorDash pays him $24. And that's what he was doing nonstop.
And so I reserve the right to be a grumpy old man about something like this.
No.
The people at DoorDash are convinced that they have a business because they are taking money for that transaction. And that's just, I don't know. I feel like that world is so broken. If you are building heat shields for rocket ships, fair enough. But you're delivering food, and it's not a business if you can't fulfill it for less than you're charging 9 times out of 10.
What the crazy part,
the perfect example of Uber. Like, we grew up in this time where, like, look, I remember being in LA back in the day with Uber rides $10 across LA. I remember seeing the same thing. I was in Dubai being like, I'm paying
100%.
$15 to go like across Dubai, and the other end, like, and then now we know what the actual costs are, and it's back to like in New York. I know, for example, people are like, yeah, I'm trying to get back in a taxi again because that's actually more affordable. And so this whole thing was subsidized in the hope that they'd have some little tweak that would take it to the next level, and it ended up it didn't. And all that innovation was just a big like throwing money into the giant circus of venture capital.
free game alert. If you come to LAX, you come to LA, take a local cab from LAX, and it's cheaper than an Uber every time. And to that point, Warren, I remember when I first started coming out to LA, everyone was just drunk driving everywhere. That's one good thing Uber did, right? I think that they cut down on a ton of drunk driving. But I remember people I had homies move here, and they were like, I don't even need a car. I'm just going to Uber everywhere. And they were in the beginning because, to your point, Ubers were literally like $8, $12 across LA. And now, you spend $600, $700 on Ubers in a month, no question, if you weren't driving, right? So
I'm saying, anyway. to get to Chateau, I'm saying, from SVB, like it is what it is. Yeah, it
is what it is. You got to pay what you got to pay. You know what I mean? Like, and sometimes
it's a tax. Every time you put it, there's a Chateau tax, much like airport tax. Like when you pull in, they're like,
we call it VAT. It's the VAT. You know what I'm saying? It's the VAT.
Flamingo Estate, even higher tax. Yeah.
It's like $3 just to come within a quarter mile. That's it.
100%. It just gets taken off.
Is that how it works with the food trucks in Portland, or do they give you money to help support the local infrastructure?
I was trying to roll something off.
But you didn't have anything because that's the kind of innovation that happens in Portland. Sorry, I'm just joking. All right, but we are at the end of we're doing a new format now. As you can tell, it's just fast, it's just furious, and this is the end of this pod.